Rally stall, stocks giving back earlier gains, but financials are keeping them in the green. Well, hello to all of you out there in cyberspace. You are watching Futures Now, and I'm Mandy Drury, your host for the day. I'm sitting in for Jackie DeAngelis. We have a very special show planned for you today, so let's introduce the crew. You've got Jim Murio, he's in Chicago on the floor of the CME, Anthony Grisanti out at the NYMEX, and our special guest trader today is Peter Schiff of Euro Pacific Capital. Welcome to all of you. And lots to talk about, but not a lot of time, so let's get straight to it. We also have Marc Faber of the Gloom, Boom and Doom Report. He is here with his 2013 predictions, and he's just called into the show, so let's bring him in. Marc, welcome to the show. Great to have you on CNBC once again. Let's hop to it. What's 2013 going to bring to us? Marc, what will 2013 bring?
2013 will bring, obviously, a lot of surprises for investors, and I'm sorry to say, probably not on the very positive side. I think that equities, after possibly some more near-term strength, will essentially decline in most countries. The exception to that could be Japan, Vietnam, and China, because they underperformed over the last 4 years so badly.
Apart from them, what would be the catalyst for that 20% decline, Marc?
Well, I mean, there are many reasons why it could happen, but I suppose that earnings could disappoint, that the fiscal issues are not resolved, that we will have tax increases and more spending. That will have a negative impact on the economy. I just came back from Egypt and Ethiopia. I think there are really numerous countries that are basket cases where there is very little hope for any improvement. That will then spill over into social unrest and geopolitical tensions. I think there are many catalysts that could really trigger a significant market decline.
And what would happen to bonds in that scenario, Marc?
Well, I think that bonds could rally somewhat from here because they're very oversold, but I think we've seen the lows in interest rates, and I wouldn't buy U.S. Treasuries for the simple reason that in time the credit rating of the U.S. will continue to deteriorate. We very clearly have deficits that aren't going to go away anytime soon. In fact, the deficits could even go up if the economy weakens.
Peter Schiff, come in here.
And Marc, nice to see you. You know, you mentioned you're bullish on the Japanese stock market. What do you think about the Japanese bond market? Do you think the latest efforts by the Japanese government to create inflation might provide the pin to prick that bubble in bonds in Japan?
Yes, I think so. I think if you look at the bonds market and the stock market in Japan, it has moved strongly inversely. In other words, after 89, stocks went down and bonds went up. In other words, interest rates went down. And I think, like elsewhere, we are at the turning point where bonds will start to decline. In other words, interest rates in the world will go up because investors will realize that sovereign bonds are not particularly safe.
And if the Japanese buy more equities and maybe buy more gold and not as many bonds, do you think it also might impact the U.S. bond market? Might the Japanese savers be divesting themselves of U.S. treasuries as well?
Yes, I think the U.S. Treasury market is completely unattractive, but we are oversold, and on stocks we're overbought. So you could have, say, for the next 1 month or so, a rebound in bonds and declining equities. But in general, I think U.S. Treasuries are undesirable for many different reasons, partly because interest rates in time will go up, and number two, all I hear all the time is how natural gas and the increased oil production in the U.S. will be a game changer. Well, the market doesn't seem to think that way because the dollar is even weak against an even thicker currency, which is the euro. So one would have to conclude that the US dollar is a very, very sick currency if it's weak against the euro.
In which case, would you be a buyer of gold this year, Marc?
I'm buying every month gold, but I would prefer to see a final sell-off in gold to shake out the relatively positive public that holds gold on margin and speculates in gold. And then I would increase my position again more meaningfully. But as I said, I will never sell my gold in my life as long as I have to look at people like Mr. Bernanke and Mr. Obama and the U.S. Congress, and I will always buy every month some gold.
It's Anthony Grisanti in New York, Marc. I was wondering, where do you see the price of oil going in 2013?
Well, I think the fundamentals of the oil market are actually quite favorable, because in emerging economies, the demand will continue to increase. It's not going to go down meaningfully. Even if the economies in China and in India weaken, we have a very low per capita consumption, and there are some supply constraints. So, in general, I think that prices will actually hold and probably even go up.
Marc, before I let you go, the last time you were on the show, you called the Apple sell-off, right? Do you still feel that Apple is overvalued at these levels?
Well, it's underperformed the market over the last couple of months. I wouldn't own Apple and I wouldn't buy it. I would rather be a seller of Apple on any rebound. I think the stock still has significant downside risk, but I think a lot of other tech stocks have also significant downside risk. And just to come back for 1 second on my thoughts about the market has been very strong since 2009, March. Soon, in 2 months or 3 months, will be at the 4 years anniversary of this bull market. Now, lately, you had important shares like GE, IBM, Walmart acting badly. When important shares that are reflective of the economy perform this badly, you have to ask yourself about the soundness of the entire market.
Understood. Marc Faber, thank you very much for joining us once again of the Gloom, Boom and Doom Report.
Pleasure.
Thank you. Grizz, you heard the man. How are you trading what you just heard?
You know, Mandy, I do see some headwinds, so I'm going to look to short the E-mini S&P, the March contract. I'm going to short it at 1470 because there's a huge amount of resistance between 65 and 75. I'm going to put a tight stop at 1477 because I think if we get through that 75 area, then we're off to the races to 1500. And I'm looking to buy it back at 1451. And earnings have been mixed at best. And I see a lot of headwinds with the debt ceiling and also the debt negotiations that are coming later on as far as cutting spending.
Jim, what do you think about Grizz's trade?
I think today is a very key day. And if we made new highs, broke out of the last week's range, and then failed and closed poorly, I am totally right with Grizz. But conversely, I see a lot of tailwinds going forward. I see housing market. I see things going on in Japan and China that could definitely provide tailwind for the U.S. stock market. But the longer-term story shouldn't be confused with the shorter-term story. If we fail today, that'll mean it's overbought and it's a position trade and it will go lower.
Absolutely. I mean, just to paraphrase what Marc was saying. Yeah, go for it, Peter.
Yeah, I'm far more interested if you're looking for a trade. Look at the action in the foreign exchange markets. I think you see a real breakdown of the dollar. Particularly, look at the euro. I mean, there's a lot of people that got short the euro. A lot of those shorts need to cover. You might want to check out the Canadian dollar. That thing has barely moved relative to some of the other commodity currencies. I think there's a lot of potential there. You know, the Canadians have been making a mistake. They've been afraid to allow their currency to rise. Just kind of like the Swiss are afraid to let their currency rise against the euro. That's a mistake. A strong currency is a positive for the nations that earn that currency, that own that currency. And I think you got to look at what's going on in the foreign exchange markets. And Marc Faber talked about a shakeout in gold. We might have already had it. We've already shaken out a lot of the weaker players. It could be time for a rally right now.
And define breakdown in the U.S. dollar, Peter. I mean, what, an orderly move to the downside or a disorderly breakdown, if I want to use that word in its correct manner?
Well, technically, look at the move today. Look at the dollar index just breaking down below 80. It's kind of broken a short little bit of an uptrend that it was in over the short run. But I'm not talking about the ultimate breakdown. Eventually, the dollar is going to collapse. I mean, you're going to see a precipitous decline. Until then, the decline is going to be orderly. But then it's going to be disorderly. And it's going to be a currency crisis and then a sovereign debt crisis that ultimately forces the U.S. government to deal with these enormous problems that we have. Until then, it's going to be business as usual. We're going to keep on borrowing, spending, and printing until the world's financial markets, the foreign exchange and the bond markets put an end to that party.
I mean, certainly we need a wake-up call of some kind. I hope that a complete collapse of the dollar is not what it is. Okay, let's bottom line Rich's trade with the risk-reward here. He's getting short the S&P at 1470, and he's looking for a move lower to 1451. Remember, each dollar move, the S&P mini contracts, is worth $50. So this trade risks $350 to make a potential $950.